right, let's get right into it. Welcome back to Iron Financial. I am your lead analyst, and today we are executing a skyscraper-level structural inspection of the absolute biggest net lease REIT in the world. We're talking about Realty Income, ticker symbol O. The stakes for this explainer are honestly incredibly high right now. The entire market wants to know, is Realty Income's famous Dividend Aristocrat Foundation completely unbreakable? Or is this massive commercial structure finally starting to show signs of structural fatigue under the crushing weight of our current macroeconomic conditions?
And I am your market skeptic, and I'm here to find the cracks in the concrete. You know, management absolutely loves to parade their top-level numbers around, but we are here to help you forge a much stronger portfolio and cut straight through all that Wall Street noise. We really need to drill down today. We need to figure out if this company is built on solid bedrock or if we're just looking at a mirage of financial engineering that's propping up a legacy brand.
So I am throwing the first punch today with the headline number. Management is out there parading a Q2 adjusted funds from operations, or AFFO, that is up 3.8% year over year. That brings us to $1.09 per share for the quarter. Now, on the surface, sure, a 3.8% bump sounds perfectly fine. But the absolutely critical question any individual investor needs to ask right now is this. Is a 3.8% growth rate actually real structural growth? Or is this literally just the bare minimum required to keep the lights on and keep that dividend flowing? I mean, in this environment, 3.8% might barely cover your own inflation costs. Okay, but you are completely ignoring the forward momentum here. That 3.8% is just a snapshot of one single quarter. If you actually look at the first 6 months of the year, AFFO per share was $2.22. That is an accelerated 5.2% growth over the first half of the prior year. You literally cannot just isolate one quarter and ignore the compounding structural integrity of their entire year-to-date performance.
Let's look at the actual blueprint for the rest of the year. Management isn't just sitting back on that 3.8%. They're actively raising their full year 2026 AFFO guidance to a range of $4.44 to $4.45 per share. So at the midpoint, that implies roughly a 4% growth rate versus the prior year. And why are they increasing their internal projections? Because they are actively deploying massive amounts of capital. Specifically, they deployed $2.6 billion this quarter at a huge 7.3% initial weighted average cash yield. By the way, before we dive deeper into the load-bearing pillars of this massive REIT, make sure you hit that subscribe button to Iron Financials so you never miss one of our portfolio stress tests.
Yeah, well, we'll see if that $4.45 actually holds up under the weight of their massive equity issuance. But sure, let's grab the hard hats and head down to the basement.
Exactly. Let's move right into our first deep dive. Is the foundation cracking? We're drilling down into the financial core. Listen, every single successful real estate portfolio requires heavily reinforced, load-bearing pillars of revenue. There's no way around it. So we need to inspect exactly how Realty Income's top and bottom lines are holding up. And frankly, here is that heavily reinforced top line. Total revenue absolutely jumped from $1.41 billion in Q2 of last year straight up to $1.55 billion in Q2 of this year. That is a highly durable revenue engine just churning out cash month after month. And importantly, that top line revenue translates directly into the bottom line, moving AFFO per share from $1.05 up to $1.09 year over year.
Hold on a second. Let's step back and look at the actual yield of this structure in the real world. Sure, revenue is up, and AFFO is sitting at $1.09. But when we look at the broader macro environment we're living in, I have to fiercely debate if a 3.8% AFFO bump is really enough to beat inflation over a sustained period. And more importantly, does it justify the current valuation of the stock? Seriously, if your AFFO is barely outpacing the consumer price index, your real return is practically zero. You're basically just treading water in a very expensive life jacket, just hoping the current doesn't eventually pull you under.
And honestly, here is where I'm bringing a sledgehammer to their operating metrics. Let's talk about the same store rental revenue growth. This is the organic growth of the properties they already own. This is the true test of actual pricing power. For Q2, we are looking at a really sluggish 1.2% year-over-year growth rate across their 14,619 properties under lease. And if you look at the year-to-date figure, it's an even weaker 1.0%. I am seeing severe cracks in the concrete here. Is 1.2% same-store rent growth a rock-solid floor, or is it actually a sluggish ceiling that proves they have absolutely zero leverage to raise rents on their existing tenants?
Okay, I am going to immediately deflect that blow because you are fundamentally misunderstanding the net lease business model. These are triple net leases. They have embedded, fixed escalators that are specifically meant to provide a rock-solid floor, not volatile spikes. They aren't supposed to jump 10% a year. That's not how the math works. But if you really want to test their pricing power in the open market, you have to look at the rent recapture rates. During the second quarter, on properties that were released, they achieved a rent recapture rate of 102.7%. And for the first 6 months, it was 103.0%. That means when a lease expires and they put that property back out on the open market, they are commanding a higher premium. Those positive leasing spreads prove that their real estate underwriting is absolutely bulletproof. Okay, fine, the underwriting might be solid, but let's talk about the leverage holding this whole thing up. I am zeroing right in on the balance sheet now. Realty Income is carrying a net debt to pro forma adjusted EBITDAre of 5.4x. Now, if you factor in the $1.2 billion of unsettled ATM forward equity, they claim it's 5.2x, but 5.4x is the reality on the ground today. That is a massively heavy structural load. In a higher-for-longer interest rate environment, carrying 5.4 times debt to EBITDAre could very easily cause fractures when they are inevitably forced to refinance their maturing debt at much higher prevailing market rates. That argument just doesn't hold up to an actual engineering inspection of their capital stack. Let's be real. Realty Income has a heavily reinforced balance sheet engineered specifically to withstand rate volatility. Let's literally list out the ironclad metrics. 91.8% of their debt is fixed rate, so they are heavily insulated from day-to-day rate fluctuations. They have a 4.7x fixed charge coverage ratio, meaning their cash flows easily service their obligations without breaking a sweat. Furthermore, Fitch Ratings literally just assigned them an A credit rating upgrade with a stable outlook, specifically citing their cycle-tested performance. And to top the whole thing off, they just expanded their multi-currency unsecured revolving credit facility up to a massive $5.5 billion, along with expanding their commercial paper programs to $5.5 billion. There is absolutely no liquidity crisis here.
Look, liquidity isn't the issue. Dilution is the issue. I am pushing back super hard on their equity issuance strategy. During the second quarter alone, they sold 13.7 million shares via their ATM program. And right now, there are 21.1 million shares under outstanding ATM forwards. That is $1.2 billion of unsettled ATM forward equity outstanding. To an existing shareholder, that unsettled equity is like rust on your position. When those forward shares actually settle, it severely threatens to dilute future dividend coverage. They are essentially just printing new shares to fund their acquisitions, which artificially inflates total AFFO, but totally dilutes the AFFO per share for the everyday retail investor who's left holding the bag. But they are issuing equity precisely because their deployment opportunities are so accretive right now. Let's look at the next phase of this build. This is the $10 billion pipeline. Management is so confident in their global pipeline right now that they officially boosted their full-year investment volume target from $9.5 billion up to a staggering $10.0 billion. And this isn't just some hypothetical projection on a whiteboard. They have already completed a massive $5.3 billion of deployment year to date. In Q2 alone, they invested $2.6 billion globally. They are scaling at a pace that almost no other REIT on the planet can match. They're leveraging their cost of capital to gobble up high-quality real estate while all their competitors are sidelined by tight credit markets. But the absolute most crucial point here is exactly how they are funding this. I want to dive deep into their private capital pivot. They recently launched an immense $6 billion programmatic hyperscale data center joint venture with Cloud Capital. Think about that. This is a once-in-a-generation data center opportunity, and they are executing it alongside heavy-hitting private capital. Furthermore, they are aggressively expanding the Realty Income investment management platform. They launched their inaugural U.S. Core Plus fund, raising over $1.5 billion in third-party equity. This is undeniable proof of their alternative fee-generating power. They are actively reducing their reliance on public equity issuance by tapping directly into institutional private capital to fuel this growth engine. Okay, well, let's stress test the math on this global deployment, because this is where the metal meets the meat grinder. Let's look at their European expansion and the actual yield spreads. In July 2026, they issued 600 million euros of senior unsecured notes at a 3.625% interest rate. Now, management loves to boast that the $2.6 billion deployed this quarter achieved an initial weighted average cash yield of 7.3%. So yeah, on paper, borrowing euros at 3.6% to buy properties yielding 7.3% looks like a massive, durable spread. But is that spread actually real?
When you factor in the massive general and administrative costs of running a complex transatlantic operation, currency hedging risks across volatile foreign exchange markets, and the premium they're paying for these overseas assets, I really have to question if that nominal yield spread actually translates into real risk-adjusted value for the retail shareholder. It translates directly into diversified, highly reliable cash flow. But, okay, let's take this explainer down to the tenant level. We're stress testing tenant credit. We need to verify if the actual occupants of this commercial skyscraper are paying their rent on time. And honestly, the numbers here are ironclad. I am pointing directly to their occupancy rate. They just reported a 98.8% year-to-date actual occupancy rate, and that is across a portfolio of over 15,500 properties. That absolutely beats their own internal guidance of roughly 98.5%. Maintaining near 99% occupancy at this kind of immense scale across multiple geographies and thousands of individual leases, that is a clear indicator of absolute, unyielding structural integrity. An overall occupancy rate just hides the rot in the specific beams of the structure. I am closely examining their structural load distribution and specifically their industry concentration risks. The portfolio is heavily skewed toward retail. We're talking 78.3%. Industrial is growing, sure, at 16.2%, and grocery sits at 11.1%. But my major concern is the non-investment grade retail sector. You have to look at the earnings release closely. They took a $54.2 million provision for property impairments in Q2 alone. That isn't just pocket change. That provision is a direct admission of potential non-investment grade tenant bankruptcies. If the consumer weakens any further, that 78.3% retail exposure is going to feel like a wrecking ball hitting the side of the building. A wrecking ball? Come on, that's completely hyperbolic. I will push back very hard against these bankruptcy fears. Let's look at the actual credit quality. 34.3% of their annualized base rent is backed by rock-solid investment-grade credit. That represents over a third of their total rent roll generated by clients with literal fortress balance sheets. And their strategic shift towards industrial assets, which, by the way, made up 75% of their domestic real estate investment this quarter, is purposefully upgrading the portfolio's credit profile and actively preventing any sort of widespread structural collapse. And to put a definitive cap on this argument, I'm delivering the ultimate authoritative mic drop directly from the architect himself. CEO Sumit Roy stated, quote, "We are leveraging our scale, relationships, and track record to access new sources of growth while maintaining the same disciplined underwriting standards that have defined Realty Income for decades," end quote. This isn't some fly-by-night firm chasing risky yield. This is a highly calculated, data-driven, cycle-tested underwriting machine that has literally delivered 133 dividend increases and over 660 consecutive monthly dividends. Look, decades of history simply do not guarantee future returns in a completely shifted macroeconomic regime. Let's step back from the granular data and get to the bottom line. It's time for the final verdict. All right, let's do a rapid-fire summary of this inspection. The structural strengths are glaringly obvious to anyone paying attention. They have a heavily reinforced balance sheet with 91.8% fixed debt and an A rating from Fitch. They just boosted their massive investment pipeline to $10 billion, fueled by an absolutely brilliant pivot into private capital and a $6 billion data center joint venture. And most importantly, they raised their 2026 AFFO guidance to $4.44 to $4.45 per share. In my view, this is without a doubt a foundational buy for yield.
And here is the opposing report from the inspection site, because the vulnerabilities are impossible to ignore. You have a sluggish 1.2% same-store rent growth that barely moves the needle against inflation. You have a heavy 5.4x leverage ratio that introduces severe refinancing risk in a higher-for-longer rate environment. And you have a massive $1.2 billion unsettled ATM forward equity overhang that threatens relentless dilution to the retail shareholder. So for me, this is a tread lightly trap. The yield might be there today, but the capital appreciation is firmly capped.
And now, we turn the final structural inspection over to you. Is Realty Income, ticker symbol O, the unbreakable cornerstone of your dividend portfolio? Or are you seeing the same structural fatigue that my co-host is worried about? We want you to comment down below with your exact portfolio allocation. Are you buying the dip or are you waiting for the concrete to crack? You decide if this stock is a yield trap or a foundational play in today's intense macro environment. Let us know what you think and make sure to subscribe to Iron Financial right now to forge a stronger portfolio. We'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.